Welcome back to Tesla Daily News Podcast. Today is February 21st, 2026. We're breaking down the biggest Tesla headlines that could actually move the stock: Cybertruck pricing and demand signals, Robotaxi safety and regulation, a key California sales license decision, and the policy crosswinds hitting EV economics. First up, Tesla just made the Cybertruck cheaper, and that's both a demand boost and a margin question. Tesla launched a new all-wheel drive Cybertruck starting at $59,990 in the US, calling it the most affordable Cybertruck yet. At the same time, Tesla cut the top Cyberbeast trim by about $15,000, from roughly $114,990 down to $99,990. The context here is simple. Cybertruck has been the most polarizing product in Tesla's lineup, and pricing has been a moving target as Tesla tries to convert attention into actual sustained volume. The details matter for investors. A lower entry price broadens the addressable market and can lift unit demand, especially among buyers cross-shopping traditional full-size trucks and more mainstream EVs. But price cuts also signal that the original pricing and feature mix may not have been aligned with real-world demand. For Tesla, the key question becomes whether incremental volume can offset lower gross margin per vehicle. Impact on the stock. Traders often like demand stimulation headlines in the short term, but analysts will immediately translate price cuts into margin pressure, particularly if Cybertruck production is still ramping and costs haven't fully come down. Takeaway: watch for signs that Cybertruck mix shifts toward the new $60,000 trim. If Tesla can drive volume without collapsing margins, that's bullish. If cuts continue, Wall Street will start modeling a structurally lower profit profile for the truck. Second story: Tesla says the first Cybercab has rolled off the line, but the timeline and economics still need proof. Multiple reports point to Tesla building its first Cybercab unit at Giga, Texas, with Elon Musk reiterating a claim that a consumer Cybercab could cost under $30,000. Here's the context. Tesla's long-term valuation debate is still autonomy. If Tesla becomes an at-scale robotaxi network, many investors will treat it less like an automaker and more like a software and mobility platform. But the details are where skepticism lives. First unit built is not the same as high-volume manufacturing, and a sub-$30,000 price point implies either aggressive cost reductions, significant simplification, or thinner margins, unless robotaxi economics shift profits to service revenue. Impact on the stock. Autonomy optimism can move Tesla quickly, but this also raises execution risk. When Tesla makes big timeline claims, the market increasingly demands evidence: regulatory approvals, safety performance, and operational scale. Takeaway: as an investor, focus less on a single prototype milestone and more on whether Tesla can show repeatable builds, cost targets, and a credible path to fleet operations. Third story: Robotaxi safety headlines are back, and they're not flattering. Coverage citing U.S. safety data reported that Tesla's test robotaxi operation in Austin is experiencing crashes at a rate roughly 4 times higher than human drivers. The reporting referenced federal safety data, with figures that suggest a higher incident frequency during the test period compared to typical human-driven rates. Context: Tesla's autonomy narrative is only worth a premium multiple if the system is demonstrably safer than humans at scale. If the opposite is perceived, even temporarily during a test phase, it becomes a regulatory and brand risk. Details: these kinds of comparisons can be messy because driving environments, exposure, definitions of crash, and miles driven can differ. But markets trade headlines, and regulators react to patterns. Impact on the stock. Negative autonomy safety stories can compress Tesla's autonomy optionality in valuation models. They can also raise the probability of more oversight, slower permitting, or constrained expansion into new cities. Takeaway: don't ignore this. If you're long Tesla for autonomy, safety performance and regulatory acceptance are the 2 leading indicators you should track every week. Fourth story: Tesla quietly admitted key operational realities about Robotaxi and tried to spin it as an advantage. Tesla filed comments with California regulators indicating its Robotaxi service still relies on in-car human drivers and domestic remote operators. Tesla argued that using US-based support is preferable to rivals that have faced criticism over remote assistance labor being offshore. Context: investors often hear Robotaxi and picture fully driverless, scalable service. But in the real world, many autonomy programs use remote assistance and, in Tesla's case here, apparently still need in-vehicle drivers in certain operations. Details: this is important because it changes the unit economics. If every vehicle requires a paid driver or frequent remote intervention, the margin structure looks much more like a ride-hail business than a software platform. Impact on the stock. This can cool near-term robotaxi enthusiasm. Analysts may push out the timeline to meaningful profit contribution from Autonomy and reduce the probability-weighted value they assign to Robotaxi. Takeaway. The big investor question is not whether Tesla can run a supervised service. It's whether Tesla can reduce human involvement fast enough to reach true scalability. Fifth story. New York just slammed the brakes on unmanned robotaxis, and that matters beyond Waymo. New York's governor dropped a proposal that would have allowed unmanned robotaxis outside New York City. The pushback reportedly included labor and transit concerns. Context. Autonomy isn't only a technical problem. It's a political and regulatory one. If major states slow walk or block deployment, it limits total addressable market and delays the revenue curve. Details. While this is a direct hit to Waymo's expansion plans, Tesla investors should care because it signals how hard it may be to get broad approval for driverless operations, especially in dense, union-influenced regions. Impact on the stock. Autonomy timelines that stretch out tend to reduce near-term valuation support. The market will discount Autonomy more heavily if regulatory wins are limited to a few favorable geographies. Takeaway. Even if Tesla nails the tech, expect a patchwork rollout city by city and state by state, not a nationwide overnight flip. Sixth story. California regulators chose not to suspend Tesla sales, removing a major near-term overhang. California regulators decided not to suspend Tesla's license to sell cars in the state. Instead, the company reportedly had a window to make changes, and regulators determined it had sufficiently addressed deceptive marketing concerns. Context. California is a critical U.S. EV market. A sales suspension, even temporary, would have been a major delivery and revenue disruption and a serious reputational blow. Details. The underlying issue centers on marketing language and consumer expectations around driver assistance and autonomy. This ties directly into Tesla's broader brand promise and the scrutiny around autopilot and full self-driving. Impact on the stock. Avoiding a suspension reduces headline risk and lowers the probability of immediate delivery hits in Tesla's most important U.S. state. Takeaway. This is a short-term positive, but it also reinforces that Tesla must be extremely careful with autonomy claims. Regulatory tolerance is not unlimited. Seventh story. U.S. policy and regulatory credits could face fresh pressure, and that hits other income lines investors often overlook. Reports point to changes around U.S. efficiency accounting rules, specifically the removal of an advantageous multiplier that inflated EV fleet efficiency under fuel economy standards. The practical implication is that regulatory credit dynamics could shift, potentially reducing Tesla's ability to generate the same level of high-margin regulatory credit revenue over time. Context. Regulatory credits have historically been meaningful to Tesla's profitability, especially in periods where automotive margins are under pressure. Details. If credit values compress or demand from other automakers changes, Tesla may need to rely more heavily on core automotive gross profit, software monetization, and energy growth to sustain earnings power. Impact on the stock. Anything that threatens recurring high-margin credit revenue can weigh on earnings forecasts, especially if vehicle pricing remains competitive. Takeaway. When you model Tesla, don't treat regulatory credits as guaranteed. Watch the policy environment just like you watch vehicle ASPs and margin. Let's wrap it up. Today's big themes were: Tesla is leaning hard into Cybertruck price cuts to drive demand, autonomy progress is being counterbalanced by safety and regulatory friction, and policy shifts could reshape credit and profitability tailwinds. For tomorrow, keep an eye on two things: any additional pricing or inventory signals around Cybertruck demand, and any regulatory updates that tighten or loosen the path for Robotaxi expansion. If you want this daily, subscribe to Tesla Daily News Podcast and follow for the next episode with the most stock-relevant Tesla updates.